So the next paper is by the speaker or the presenter is Biwesh. Tax threat. We're going to talk about tax threat and disruptive market power, foreign portfolio investors. And Biwesh is from Strathclyde.
Good morning, everyone. My name is Biwesh Neupane. I'm from University of Strathclyde. First of all, I'd like to congratulate Rasa and Rina for that wonderful paper, and then thank GDI and Emerging Market Conference for this opportunity to present the paper, which is titled Tax Threat and Disruptive Market Power of Foreign Portfolio Investors, co-authored with Andrew Mossel and Chandra Thapa from University of Strathclyde and Suman Neupane from Griffith University. So to begin with, the importance of foreign portfolio investors, particularly in capital constrained emerging markets, has been well documented in the literature. For example, the higher foreign portfolio investments is related to a lower cost of capital, which in turn increases the real investment opportunities for the firms. Considering these benefits, these opportunities, regulators often shape policies, they formulate regulations, they create an environment not only just to attract foreign portfolio investors, but also retain these foreign portfolio investors. There is a recent literature by Kerner in corporate political studies in 2015 who suggests that foreign portfolio investors also have a power to influence the policy making by influencing the shareholders, the managers, who in turn have lobbied the regulators to make changes in the host government policies. In this study, what we argue is that we extend this literature by arguing that foreign portfolio investors also has a direct market-based means of instituting changes in the host government policies by withdrawing from the market if they find the policies is not conducive to their investment preferences. So in this study, we particularly focus on the Indian setting part, mainly because of three reasons. First, we look at an exogenous event that created a threat of tax for the foreign portfolio investors in India in 2015, they particularly related to minimum alternate tax in 2015. So the minimum alternate tax is basically an alternative tax mechanism which was formulated for the zero tax companies to pay a minimum of 18.5%. That rolls out to around 20% of the net profit. However, there was a certain uncertainty whether foreign investors are subject to this minimum alternate tax or not. In July 2010, Authority for Advanced Ruling, they ruled that foreign investors, including foreign portfolio investors who do not have permanent establishment in India, are not required to pay minimum alternate tax on their income. However, in August 2012, they overturned their own decisions, arguing that MAT effectively overrides the double treaty taxation agreement, and hence even foreign investors, including foreign portfolio investors, are required to pay the minimum alternate tax. However, this ruling did not create so much of panic because it was challenged in the Supreme Court and the decision was pending in the Supreme Court. However, in February 28, 2015, in the budget session, the then Finance Minister Arun Jaitley announced that from effective to April 1, 2015, foreign portfolio investors will not be liable for minimum alternate tax for the transactions conducted after April 1, 2015. So this announcement basically opened the Pandora's box because they announced that foreign portfolio investors would not be required to pay any minimum alternate tax on the transactions conducted after April 1, 2015, but it created uncertainty whether tax would be imposed retrospectively. And beginning at the end of March 2015 and the beginning of the April 1, 2015, the Indian Tax Department, they effectively send out notice to the foreign portfolio investors demanding for the minimum alternate tax for the transactions that were conducted before April 1, 2015, as Indian Tax Department has the authority to demand for taxation up to previous 7 years. So it was widely covered in the media as well, covered by Financial Times, where almost 100 FIIs, they got a tax notice and it was valued to be around $6.4 billion. It was covered by Financial Times. Wall Street even called it a tax terrorism, return of tax terrorism in India, and they were going ahead, and Arun Jaitley, they commented that government would go ahead with pressing an additional tax of 40,000 crore demand on FIIs. So we look this event as an exogenous shock. If you look at the timeline, basically this is the timeline that we just discussed. So On February 28, they made the announcement with an effective date of April 1, 2015. At the beginning of April 5, Indian Tax Department, they intensified the tax demand, and because of the different hue and cries by the foreign portfolio investors, eventually government formed a committee that looked at the matter related to minimum alternates, particularly to the foreign institutional investors, and eventually they submitted a report, detailed report. And on September 1, 2015, government retraced their decisions and said that the minimum alternates tax would not be imposed to foreign portfolio investors, both retrospectively and prospectively. So we consider these two events as a window period, and we look at this exogenous event to address three particular questions, very simple questions. First, we look at the direction and size of the reaction of foreign portfolio investors following the effective date of the MAT announcement. Second, we also look at the implications. What were the implications when foreign portfolio investors withdraw from the market, especially on the stock market, such as volatility, turnover, liquidity, and the pricing impact. And finally, we also examine the response, both direction and the size of FPIs once the government removed the tax rate on September 1, 2015. So basically, we only look at the trading data for the year 2015. Findings, we get a very straightforward answer for these three questions. We find that foreign portfolio investors withdraw from the market, and it was also significant as well as economically meaningful. For instance, we found that there was a decline of 0.309 basis point, which translates economically into 7.27 million of market capitalization for each day for each equity, which is really huge. Next, we also find that the outflow, that is the withdrawal from the foreign portfolio investors, had a detrimental effect in terms of the stock volatility, stock liquidity, turnover, as well as it has a huge pricing impact in the market. However, after the second announcement, we find that there was no substantial inflow or no immediate or substantial inflow, even though the government retraced their policy and announced that the tax would not be imposed. So we basically find these three straightforward results. Contribution, we basically make a few contributions to the literature. Most importantly, we provide a new channel through which foreign portfolio investors can influence the host government policies through their direct market withdrawal response. We find that the market withdrawal response forced the government to reconsider the policies and make policies conducive to these foreign portfolio investors. We also contribute to the literature on tax avoidance and foreign portfolio investors in emerging market. There is a huge literature that suggests that foreign portfolio investors are sensitive to tax policies. However, we do not. There is a little empirical evidence on how these policies affect and what is the magnitude of their reaction, and we find that reaction. We also look at the literature whether tax subsidies are important to foreign portfolio investors. The literature by Razan, they argue that for the tax subsidies are an important consideration for the foreign investors to reduce the information asymmetry compared to the local investors who have better knowledge about the market regarding the investment opportunities. We argue that, but however, there is no empirical evidence whether foreign portfolio investors are given tax subsidies and how these foreign portfolio investors react to such tax policies. We make a methodological contribution as well in terms of tax avoidance. There are different proxies that has been used. However, these proxies have a construct validity and the issue of endogeneity. We use an exogenous shock to eliminate these kind of concerns. And finally, we also contribute to the literature where we look at whether foreign portfolio investors have a destabilizing or a stabilizing effect in the market. So there's a both argument. One of the arguments suggests that the FPIs have no stabilizing effect, whereas other argues that they do stabilize the stock market in emerging markets. In this literature, we show how the reduction in foreign portfolio investors affects the stock market. So this graph basically summarizes our whole study. So as you can see, at the beginning of January to February to the March, there is a positive foreign portfolio investments, but immediately after the April, we see a huge decline in foreign portfolio investments, and this is where we try to format our study. We conduct a difference analysis. So basically, we do not have a natural treatment group. It would have been great if we have access to the domestic institutional investors trading, but we do not have that. So in order to formulate a treatment and control group, we calculate the total foreign portfolio trading for each sector beginning 2003 to 2015, and designate top 30% as a treatment group and bottom 30% as a control group. And we conduct a mean difference and different test analysis. So as you can see, beginning pre-market period, the foreign portfolio trading, this in basis point is relatively similar, whereas the difference after the post-mat period, there is a huge decline in treatment group, which is statistically significant. And the difference in difference results in minus 0.22 basis point, which effectively translates into 4.76 million. We also conduct a DID regression. Yeah.
What is 4.76 million?
It is the market capitalization for each day for each equity. So this, we look at the net equity trading scale by the market capitalization.
So you're saying that there was a change in the foreign investment net flow
Yeah.
of, on average,
4.76 million.
per firm.
Yeah, for each day. Yeah,
Per day or per month?
per day.
Per day.
Yeah. So we also conduct the difference in difference regression. We control for different pull and push factors that suggest that might affect the foreign portfolio investors. And after controlling for all these factors, we find a negative effect of minus 3.0509 basis point, which effectively translates again into 7.27 million of market capitalization. And we look at implication in terms of the turnover ratios, liquidity index and illiquidity index, and we find that the withdrawal had increased reduced the turnover ratios, increased the illiquidity index, as well as increased the liquidity index, where the liquidity index higher suggests a lower liquidity. And we also look at the stock volatility, where we find that the withdrawal had increased the stock volatility. We look at the pricing impact by conducting a trading strategy, where we take long strategies on the treatment group and short strategy on the control group, and we find that the MAT effect, the withdrawal, net equity trading had a significant pricing impact in both our long and the short strategy. And finally, we also look at this at the second announcement, where we do the similar analysis for the September 1 event, and we find that the reversal of the MAT effect did not have the same effect as the April 1, 2015. So even though the government retraced the policy, it did not immediately result in a foreign portfolio inflow, or the investors basically they did not come back immediately. So we conduct this analysis for April 1, 2015 to December 2015. So to conclude, we find that there was a significant market withdrawal as a response to the additional tax threat. The withdrawal had a disruptive effect on the market in terms of the volatility, liquidity, and the turnover, and as well as prices. And the elimination of threat, it does not lead to the immediate inflow of foreign portfolio investors. So it suggests that the host governments should be, when they make changes in the government policies, they have to look at the whether this could directly influence the benefits of the foreign portfolio investors or not. So it is policymakers should take a due considering while formulating, announcing, and implementing policies that could affect the expected payoff of foreign portfolio investors. So with this, I'd like to conclude the presentation and open the floor for the discussion.
Thank you, Biwesh. Reena?
That's the paper, and unlike Veeramani, I didn't have to suffer through 80 pages. So I had my reservation when Susan asked me to discuss the paper, and the reason being so is how we read the paper depends on reviewer-specific fixed effect. And at the last Western meeting, Lubosh Pastor took great pain in saying that correlation among reviewers have increased from 0.23 to 0.27. So Biwesh, anything I say, you have to take it with a grain of salt. And my suspicion was vindicated when last Sunday Biwesh informed me that seems like another person had a different reading. So with that said, I'll go ahead and summarize the paper and give my comments. So there are two approaches of doing research. One, you could have a big crude elephant which would have issues. And the other one is you can focus on a narrow part of the elephant, such as the elephant's trunk. And a couple of people yesterday seem to be suggesting that that's the way to publish well. I don't necessarily agree with that, but I'll give you both set of comments. So what does the paper do? And these are my reading. So the big question and the motivation kind of changed from the beginning of the introduction to the end of the introduction by the time I arrived there. But a major question, do tax subsidies work? And the authors use a revealed preference that what's the reaction to when tax subsidies are threatened, what do the foreign portfolio investors react? How do they react? And foreign portfolio investors' preference, why they decide to invest in a foreign country, given the host country bias, large literature we have, that's kind of exogenously given. The authors don't want to get into that, and that's fine. So do they respond to a policy shock in a predictable manner is the question. And then what they do is, what's the relation between, they establish what's the relation between change in tax policy. I wouldn't explicitly call it change in tax policy, rather interpretation or implementation of a policy and portfolio choice by the FPIs. Motivation for the work, again, all throughout the paper, different motivations came out, but seemed like the bright and dark sides of FPI. Certain results on liquidity, volatility, those are not fully fleshed out, so I won't give comment on that. You need more work to do, and you know that, I think. So setup, why India? And yesterday, a couple of discussions came out, oh, you need to do a better job explaining, and I don't think that, I think the authors are very aware why they are doing it, but on this case, even though they are aware, they are kind of being bashful about it. So you might just as well come out and admit that you have the exogenous shock, because remember the crude elephant is Desai and Dharampala. They have this big elephant part, and you want to do the perfect trunk. So if that's what you want to do, just come out. Don't beat around the bushes like, oh, emerging economies' reliance on foreign investors, and India has 40%, whatever. Hypothesis is the ability to influence policy with their feet, flight of capital. Method, standard difference in difference. We all seem to be going for hunting exogenous shock. It's got to a point where exogenous shock is driving the research question, and we are using traffic on a certain bridge on a certain day of the week to establish causality. So treatment and control, I'll talk a little bit about treatment and control later. Key result one, when more favorable tax treatment is eliminated, FPIs are withdrawing capital. That's what we expect them to do. And the second one, reversal of policy did not reverse the capital flow, at least in magnitude. So what's the size of the innovation in the paper is they measure the size. Size of the capital withdrawal is $2 billion per month. So I wanted to check what are the other magnitudes of other shocks. So I did a search. So the Factiva brought out some of these, and then I wanted to check. I did a Google search, and Monica is here. So Mint came up in there, one of the top 10 searches. So I've included it in their little plugin. So 5 billion withdrawal from demonetization in November, 3.5 billion. So you have 2 billion per month over 5 or 6 months. So just demonetization is getting almost close to that. So you have to argue why your number is large or small. And then September 2017, $1.7 billion cause was not given. So measurement of inflow on subsequent tax policy reversal, and these are my potential explanation. Authors just let the results hang out there and draw your own conclusion. Potential explanation one, and Ajay yesterday made comments that it's more about uncertainty about how policies would be implemented, institutional reaction. Here is the policy, vaguely defined, but is the government coming after me? That's more of a risk, I think, than the policy itself. So it's the uncertainty originating in unpredictable behavior, and when you withdraw the policy, that increases the volatility of the behavior and complicates things. And I see real option everywhere because that's what I kind of teach. So you have the real option to delay until there's a resolution of this uncertainty. So second explanation, if we recall Campbell and Hanschel's work, no news is good news, asymmetric impact of volatility, we know that, that whenever there is a news, even if it's a positive news, especially positive news followed by negative news, we'll see more like a detrimental effect than a positive effect. Potential explanation 3, and this is kind of a little bit mean, I don't want to say it's all mechanical, but why are there more escalators out of a subway station than going in? Because you have clustered withdrawal, but coming back, it would be in a slow, staggered manner. So general comments on motivation, I would say that, and as I said, I'd give both set of comments, the crude elephant as well as the refined trunk, that I would like to see scope of the work expanded a little bit. And here is the reason. Right now, the argument looks like, I'll take the corporate finance example, that I am going to, seems like you are arguing, I am going to compare different international subsidiary performance, and my measure of performance is ROA, but I'm completely going to ignore the fact that there is such a thing called transfer pricing. Transfer pricing exists. That's why any international subsidiaries, ExxonMobil doesn't book their revenue in Malaysian operation, Indonesian operation. Transfer pricing is set that all the profits are booked in Singapore operation. So you just cannot ignore transfer pricing and say, I'm going to measure subsidiary performance using ROA, okay? So where does the work fit within broader discussion of whether tax subsidies are beneficial for the offering economies? And right now we are having this debate on the US, whether the tax cut is going to pay for it, whether they're paying for themselves and are subsidy-driven investors net consumers of liquidity. And it's important because in the front part, you make the argument that because of asymmetric information, you need to compensate them by giving them tax subsidy. So they are consumers of liquidity. Then you say after the exit, liquidity declined, volatility increased. So there's some internal inconsistency in there. That's what I highlight. Minor results on liquidity volatility post-event seem to argue what you motivated in the front end, arguing for the tax subsidy. So again, the crude elephant comment, knowing that Desai and Dharmapala have big works in there, how you can contribute if you decide to go that route, and that's a matter of personal preference, can you analyze all the different channels of tax minimization strategy and impact of each of those? And I'll give you, I just don't want to send you to do something without giving that it works. Because the reason it works, if you think about Fazari Hubbard Peterson, going back, there is this debate on investment cash flow sensitivity. We thought that we would not publish well on there anymore. But guess what? 2016, there are 2 papers contradicting results. We have not resolved the dispute. And the competing paper went into JFE, but I think that speaks more about Tony Whitehead's preference than anything else, because I think Llewellyn is a better work. What they do, they take every dollar of cash flow and say, where is that cash going? Where is it getting parked? So that kind of analysis still published very well. And I see lack of systematic elimination of alternative hypothesis. And some methodological issues, I would not belabor the point. Seems like you have some data restriction. You are speaking the same set of treatment into artificially gradiated treatment and control. Your controls are actually treatment. And I know you cannot help it, but there are some diagnostics you can check. And I didn't see any effort to establish parallel trend in between your quote-unquote treatment and control before the event. But here's the major issue I have. I have taken those from robustness, but your main results also are like this. That's what we are looking at. But look at these 2 factors, US dollar volatility, and you have taken everything exogenously given, motivation for investment. But these things have big impact. But more important, in your placebo test, you say, oh, in the placebo test, this effect goes, but these effects also do not exist. So that's a big concern. So the way you can address those in the first stage, just regress these 2 on your net flow, and then work with the residuals. On the residual, then you regress. If you still get the effect, that's a better method. And then some other, I have written out all those things. Couple minor points. Your volatility measurement, I'm assuming that you are using Anderson, Ballersleb, and co-authors 2003 paper, but that's under the assumption your sampling frequency is very high and your serially uncorrelated return. In that period, you provide evidence returns are not serially uncorrelated. And try to use abnormal return using 3-4 factor model. Your long short portfolio, yields 16 basis points. That's not enough to generate after transaction cost. Finally, and I take big exception to that, by reading your paper, you make it sound like Vikrant Vig invented it, difference and difference. He has done good work, but you have to give credit where credit is due. It goes back to Ashenfelter 78, a whole host of labor economists, including David Card. So go back to the source. And I think that's all I have. I can send you the slides. I enjoyed reading the paper. It has potential, but you have to do a lot more work, and I strongly recommend everyone read the paper. Thank you.
Thank you. Absolutely. So why don't we just quickly collect questions as before, and then maybe go from there. Any questions from the audience, please? Yes.
I haven't read the paper, but I do wonder what the domestic institutional investors were doing at the same time. So DIIs over the last few years have emerged as strong players in the market. So it would be interesting to see what the DII's performance behavior was. Were they reacting to something which was not this tax decision of the government? And also, was there a global event for the FIIs which made them withdraw the money? So I'm not so clear whether it was this, because if it was, the money should have come back, no? Thanks.
I have one question. Do you have data on tax of these, the tax paid by these FPIs? Because otherwise, because the MAT basically said that for those FPIs whose tax was less than 18.5% of the book profit, this applied. So then you would get a much better treatment and control than just doing a 33% top and 30% whatever bottom.
Biwesh, it might be, would you have an idea, or would you have the identity of these FPIs, especially where they are originating from? Because if they're taking the money back, they might have tax liability in their home country also.
So basically, the database do not provide the FPI identification. They mask the FPI identification. So we do not have any idea who those FPI are.
Okay.
Okay, Biwesh, do you just want to answer the questions that come from the floor so far, and we can skip to...
I think that's fine. Regarding the DII's behavior, we do not have the exact trading level data for the same level of data we have for the foreign portfolio investors, but we can look at the I think we have the daily total volume of DIIs trading, and we can at least have a look at how they reacted overall. So we can do that. And regarding the global event, we try to address whether there was any other systematic shock during our sample period. And we find that there was one event related to Greece exiting the Eurozone, and we control for that in our robustness test, and we do not find any effect of that as well. So I think I'll discuss with her later. I think
actually we're running out of time as well.
Yeah.
So since
Thanks.
Madhu will be presenting, I'm taking over for the last part of the session.